Exchange-traded funds have emerged as a revolutionary force in the world of investing, offering investors a convenient way to diversify their portfolios across a broad spectrum of assets. With their simplicity, low fees, and potential for steady returns, traditional ETFs have captured the attention of investors worldwide. However, within the landscape of these mainstream investment vehicles, a more unconventional and curious corner of the market has taken shape: the realm of weird ETFs. Intriguingly distinct from their conventional counterparts, these weird ETFs have garnered attention for their unique investment strategies and thematic focuses. These funds often venture into uncharted territories, targeting niche industries, speculative trends, and even science fiction. While the term weird might conjure notions of peculiarity, these ETFs offer a fresh perspective on portfolio diversification and the potential for outsized returns. In this video, I'll be diving into 10 of the world's weirdest ETFs. From investing in potential encounters with extraterrestrial life, to analysing social media sentiment for market predictions, these ETFs showcase the dynamic and ever-evolving nature of the investment landscape. However, while these ETFs might intrigue and captivate, it's essential to approach them with a measured understanding of their strategies, potential risks, and alignment with personal investment goals. If you like this video and want to see more just like it, please make sure to subscribe to my channel down below. Before getting into the ETFs themselves, let's have a quick recap of what exchange-traded funds are. Imagine you're into gaming and you want to own a piece of a bunch of different gaming companies, the ones that make the Xbox, PlayStation, and Nintendo consoles, for example. Instead of buying stocks in each individual company, which could get complicated and expensive, you can invest in something called an exchange-traded fund, or ETF. An ETF is like a collection of stocks from different companies, all bundled up together. It's like buying a package deal that includes a little bit of each company's stock. So if you invest in this gaming ETF, for example, you'll own a small part of all of those game companies without having to research each and every single company's stock on its own. Another cool point is that you can easily buy or sell these packages on the stock market, just like you would with an individual stock. To carry on the trend of gaming, let's start with our first fund, called the ETFMG Video Game Tech ETF. You can find it by searching for GAMR in your broking app, such as Sharesies or Hatch. This was the first ETF to specifically target the video game industry, an industry that's expected to grow to $314 billion by 2026, with over 3 billion users globally. The industry is heavily influenced by technology, such as augmented reality, virtual reality, and e-commerce. This ETF was started in 2016, has around $45 million US under management, and has an expense ratio of 75 points. The fund currently has 91 stock positions, including the world's largest game designers such as Nintendo, Unity, Activision, Take-Two, and Sony. So if you're bullish on the future of gaming, this might be a good ETF to look into. The second fund is much more odd than the first, and that is the Procure Space ETF, trading on the Nasdaq under the ticker UFO. This fund comprises a portfolio of 36 companies that are closely involved or have a majority of their revenue derived from the space industry. This includes space and satellite manufacturing, satellite-based communications, space imagery, technology, and hardware. Over time, the fund anticipates further investment into companies that specialize in space tourism, space military and defense systems, space resource extraction, colonization, and the broader space economy. This ETF was started in 2019, has an expense ratio of 0.75%, and has $47 million under management. Among its largest holdings are New Zealand company Rocket Lab, broadcaster SiriusXM, GPS companies TomTom and Garmin, and others such as Virgin Galactic, Lockheed Martin, Boeing, and Airbus. The fund's returns have underperformed over the past few years as space remains a nascent industry with an uncertain future. If you're bullish on the performance of space-oriented companies, this ETF might be a good option to explore. Moving along to our third fund, we have a unique ETF from Korea called the K-pop and Korean Entertainment ETF. It trades under the ticker K-pop on the New York Stock Exchange. It is the first US-listed ETF that invests in South Korean entertainment equities. Over recent years, Korea has made huge strides in the entertainment domain. With BTS and Blackpink among the highest-selling musical artists today, the Korean music industry has seen a 44% growth year over year. Films and TV series such as Parasite and Squid Game have also had worldwide acclaim. This ETF exists to benefit from this tilt in the media industry towards Korea. This fund was started a year ago, has an expense ratio of 0.75%, and has a relatively small $2.7 million under management. The ETF has 32 holdings, and among its largest are social media and messaging apps Naver and Kakao, and entertainment companies such as BTS's Hybe and Blackpink's YG. If you're passionate about the Korean music industry and want to own a piece of the companies supporting your favorite artists or shows, this might be an option to consider. Onto the fourth fund, the Obesity ETF, trading under the Nasdaq ticker SLIM. Though you can no longer invest in this fund, I thought it would be a funny one to include in this list. The SLIM ETF was launched in 2016 to invest in companies positioned to profit from servicing the obese, including biotech firms, healthcare, weight loss programs, and supplement companies. The fund wasn't very popular during its lifetime, growing to just $10 million during that time and an expense ratio of 0.35%. Among its largest holdings were major diabetes care medications and device manufacturers such as Novo Nordisk and Dexcom, and others such as Fisher & Paykel Healthcare from New Zealand that manufactures products that helps with sleep apnea and respiratory issues. The fund was wound up in early 2020 when the virus started going around, but if we look at a similar index, you can see that it has been a widely profitable strategy to invest in these types of companies. The fund certainly benefited from a health outbreak in 2020, but had the fund continued, it may have become an even better performing one in this video, as you can see here. The fifth ETF in this video is a more controversial and topical one, and that is the Point Bridge America First ETF, with the ticker MAGA. The MAGA ETF allows you to invest in companies that stand to benefit from a Republican president. It is made up of 142 companies from the S&P 500 whose employees and political action committees, or PACs, are highly supportive of Republican candidates. The ETF was launched back in 2017, has an expense ratio of 0.72%, and has about $40 million under management. Among its largest holdings are trucking company Old Dominion Freight Line, Domino's Pizza, Co-America Financial Services, and others like FedEx and Charles Schwab. In terms of its industry exposure, it is heavily skewed towards industrials, energy, and financial sectors, which are at the heart of the traditional American economy. If you think America might be looking for new leadership in the next presidential race, or want to invest in more traditional industries of the American economy, this might be a good option to explore. Sixth up, we actually have two opposing funds, the inverse Cramer and the long Cramer. For those of you who don't know who Jim Cramer is, hopefully this face looks familiar from the CNBC show Mad Money. He has a reputation in investing circles for being a bad omen. If he's bullish, it's time to sell. These funds are some of the more wild options in this video, as they have just 3.3 and 1.3 million under management respectively. They also have a relatively high expense ratio of 1.2%. Some stocks currently in favor by Cramer include Walmart, SoFi, RTX, and others like Palantir, Nvidia, and Microsoft. These ETFs, though wild, are certainly not advisable for many reasons, but you can do your own research by looking under the ticker SJIM and LJIM on your trading platforms. Now onto our seventh ETF, the Advisor Shares Vice ETF, with the New York Stock Exchange ticker VICE. This ETF invests in the products and services people find pleasure in regardless of their financial conditions. This includes industries like alcohol, tobacco, gaming, food and beverage, restaurants, among others. Their justification is the fact that these industries have consistent non-cyclical demand, which means it doesn't move around too much, attractive profit margins, and innovation allows them to continue to grow, such as vaping, esports, online sport betting, and drug law relaxation. The fund has 8.9 million under management, caps its management fee to 0.99%, and it was launched in 2017. Its largest holdings are in the gaming companies NetEase and Boyd, restaurants Wingstop and BJ's, alcohol company Moet Hennessy, among others. Without a large weighting towards the tech sector, however, the fund has underperformed the wider S&P 500 index consistently. If you want to invest in traditional vices, this might be the ETF for you. Eighth up, we have the Roundhill Meme Stock ETF, which offers investors exposure to meme stocks. Trading on the New York Stock Exchange under the ticker MEME, or MEME, it consists of 25 equal-weighted US listed equities based on a couple factors. This includes its amount of social media activity through the likes of Wall Street Bets, and its short interest. Short interest is where a substantial percentage of a company's stock is sold short, meaning a short investor would need to buy the stock at a future date, irrespective of the price, to cover their position. To keep up with the latest meme trends, the portfolio is rebalanced every 2 weeks. Among its largest holdings are the early stage speculative bets that you'd expect, such as Rivian, Neo, Enphase, SoFi, and Carvana. With an expense ratio of 0.69% and just 3 million under management, it might seem like this ETF is a bit of a joke. However, it has actually performed reasonably well this year with year-to-date returns of 33%. Since the ETF launched back in 2021, however, when meme stocks were peaking, the returns have been less than spectacular, down 55%. If you want to diversify your portfolio into some highly speculative stocks, this is the fund for you. The 9th ETF is another Procure fund, this time called the Disaster Recovery Strategy ETF, with the ticker FIXT. This fund tracks a portfolio of companies that stand to benefit from the recovery efforts after natural disasters, including hurricanes, wildfires, floods, and earthquakes. With the onset of global warming and inflation pushing disaster recovery costs higher, this fund stands to benefit. The fund was launched last year, has an expense ratio of 0.75%, and manages $2 million in assets. Among its 49 holdings are infrastructure, communications, and engineering companies such as Sterling and NEC. The fund is listed on the Nasdaq exchange, and it's had a relatively good year, returning investors nearly 20% gains for the year to date. So if you want exposure to disaster recovery, this is a fund to consider. And finally, we have our last weird ETF to look at, the Millennial Consumer ETF with the ticker MILN. It should come as no surprise that this fund was created to invest in companies geared to benefit from the rising spending power and preferences of millennials in the US. Many people watching this video right now would be the target audience, with 82 stock positions we engage with the most. Looking at this list, of course there's Uber, Meta, Amazon, Google, Netflix, and a long list of others that are mainstays of this demographic. This fund is actually quite popular, with over $100 million in assets under management, a listing on the Nasdaq, and can be found on many New Zealand broker websites such as Sharesies and Hatch. It was launched in 2016, has an expense ratio of 0.5%, and has had returns of nearly 19% year to date. Since inception, it has even more than doubled. So unlike the others, perhaps this one isn't so odd, but it's a great way to close out the video with an ETF that sounds somewhat promising. So there you have it, 10 of the weirdest ETFs I could find. Let me know down below if I missed any. If you enjoyed this video, please make sure to subscribe to my channel down below to see more videos just like this one in the personal finance and investing space. Thanks for watching, and I look forward to catching you on the next one. Cheers.